Good evening, everybody. This is Gary Full from LTT Trading LLC, a commodity broker firm in the suburbs of Chicago. Today's August 26th, 2019. I wanted to go over a little bit about the market action over the last several weeks, actually, in the S&P 500 E-mini index. I think it's a very important chart, and it fits the Wyckoff schematic pretty much the way we would expect the market to be. But first, let's do a disclaimer. The substantial risk and loss in trading commodity options past performance is not indicative of future results. The opinions of those here are Gary Full LLC are not to be taken action buy or sell commodity options. This is based on the teachings of Richard D. Wyckoff, large risk in trading. Also, I want to let you know that by watching this YouTube, I want to offer you a 2 free week Wyckoff newsletter that I do. It's produced about 7 o'clock in the morning on the day of, so I can watch it markets overnight, give the latest detail to the market. If you just write to me, I'd be happy to do so. And also 1 free one-on-one webinar, mentoring webinar between you and I. It's recorded. You just pick up a link, nothing to download, and the recording is there's features that you can review. If you want to get a hold of me, please contact me at gfull@ltg-train.com, and the website is the same. So let's get to work a little bit. So what's interesting about this particular market is that the market had the opportunity to move higher from the particular highs. It did not take advantage of that. And the market then went down and went to an area that the market here went under some support. This particular bar here, it actually put itself in a situation where it told us that this particular action here, this sideways trading range, we like to call it, the actual market hit supply or selling overcome the buying in the markets. This is very, very important because all this work of the last 2 weeks, people that bought this particular market now all became in a losing position to the markets. And then the market facilitated the down move by people liquidating their long positions. We could see this by the increasing volume to the downside. We have traders that are getting out of positions that have bought the market near the highs. Those are the ones that are long from lower levels may or may not have gotten out. But generally, people that have lost sustained will get out. We then have selling to come into the market. This has become the left-hand side of this particular trading range. The left-hand side of the trading range. So I'm going to put LHS, left-hand side. When the micro schematic has this particular break from the area of the highs, we generally will form some type of trading range. A trading range is a market that is going sideways, that is building count, point figure count, or cause for the next particular move. It's like putting gasoline in a car. The more gasoline you put in a car, the longer the potential distance can go. This left-hand side of the trading market has a tremendous amount of risk because of the volatility on the left-hand side. There's always substantial risk in markets, but in a particular case, this left-hand side presents even more risk because it's when the liquidation of longs go into stronger hands who need to buy the market for liquidity to the market. It's just an extremely important function of the market, where the market goes from an overvalued situation, overbought situation. The longs begin to liquidate that market. Because the longs liquidate the market, it feeds upon the sell stop under the market. The latest longs are the ones to get out of the market because they tend to be losing money. They want to protect their equity, so they get out of the market. And then the market basically falls down. And then we see a very interesting phenomenon that happens, is that we have a large bar here, and the volume is fairly high. This is the first time that the market's ability to rally from these last several bars. And then we trade to an area right here. This line is very significant because it's this line right here that has the highest volume associated with the move. The highest volume associated. So that means that selling was prominent here because that's where the market reacted down from. If we draw a line across from here, we don't have to be perfect with our lines. We just have to show that the market has this top of this range, or this creek area, we like to call it, and the market inability to move higher from a background of selling is very significant. And then the market had a very large break on Friday. Various reasons, there's a multitude of reasons that happened. I'm sure you're familiar about it and read about it. It's not, some of it can be all true to affect the market, some of it can not be true, but nevertheless the market went down fairly substantially. When we went down fairly substantially, we know that we want to mark this particular area because this was a reactionary low, and we mark this particular low. So there are two areas in which the market has targets to the downside that the market can trade to that have a support edge to the market. It's extremely important because it's this area, as we see, this large volume area with a large range, this area needs where the market has to have demand to overcome supply to the market. Well, function, this schematic of the market breaking, left-hand side, is we have a secondary test right here. The market just building cause. We don't know if this market's going to go down to here. We don't know if the market's going to go up to here. But we establish somewhat of a lower trading range within the trading range. So kind of like packing dynamite, right? It's a small spot. It's going to maybe explode to the market, right? So the bottom line is that in this left-hand side, the market tends to go sideways for a bit, kind of consolidates and congest the move that just happened to the downside. It's like having a stroke. The market needs to go sideways to kind of land on its feet, per se. And then the market will travel as the market goes across. We see the market going across, and we see the market going to have a situation where the market is building cause, and we can deal with the edges as far as that's concerned. I talk about this in my new series that I called Wyckoff Simplified. It's on the website itself, and it's basically around, I think, 10 videos and around 30 to 40 minutes each one. So it's only like 300 to 400 minutes of this. Wait, is that correct? 30, yes. And it explains the different various efforts results in various different phases of Wyckoff. It's a very good series that I just completed. We'll be doing point and figure soon as well. So that's going to be coming up shortly. So there's a bunch of new products that are occurring. So now we're staying in the trading range, doing this for cause. And when we see the cause being built, we get a count of the next potential move. The longer that it takes the market to stay in this range, the more of acceptance of prices that we get. When we accept prices at lower levels, then the market tends to get saturated and eventually moves away from here. So if you want to look at that Wyckoff Simplified series, you can go to the website, www.ltg-train.com, and we'll talk a little more about that. So this is early in the phases of the market. We would not expect the market to mark up from this early in the phases. We expect the market to mark up or down here. As the market builds cause in the sideways action, awaiting all the news to get digested. And now in the next month, you'll have Europe coming back online. After Labor Day, activity even should pick up between now and the end of the year. So that's something to watch as well to the market. So we'll see that sideways cause. But since we have this break up here with large volume, this changes the character of the up move and now forms another trading range, and we have to determine what that is. Without demand overtaking the selling area, we could go lower to find that demand. If we get to the point we go back up to the resistance area and the market does not sell off, then the market will be accepting higher prices. If they accept higher prices, they may have to work higher to see what's overpriced to the market. So they kind of work in tandem with each other to see what happens. So what I would not expect the market necessarily to do anything substantial over the next week or so, maybe longer, maybe shorter, but I wouldn't expect I expect volatility, wide ranges within this range, but I don't expect the market to net gain or lose tremendously from this area. I would say it would stay within this trading range as the market's building costs. So I want to thank you for watching this short YouTube video. Hope you're taking me up on my offer to look at my site. There's a lot of good educational material, from newsletters to one-on-one mentoring to various different free webinars that we offer. So I want to thank everyone for taking their time, for listening to the YouTube. We'll be producing more YouTubes and hopefully have guests at our site to keep you informed about the Wyckoff method. I wish everybody a good, safe evening, and thank you for listening to this YouTube video. We'll see you down the road. Thank you very much, everybody. Bye for now.